All right, welcome back. There's a minute to go for the pre-open session. Just, getting to it, the SGX is still indicating about a 25-odd point lower start. Manoj Muralidharan is with us, Vice President Derivatives at Reliance Broking. Manoj, great to have you with us here. Thank you very much. I mean, the market here, despite all of the intraday and day-on-day volatility, and the swings have been very large, for the week ended absolutely flat. How are things set up? We were discussing this last week when you were on, that FII index future net short positions are rising. They're nowhere near what they were at the lows in June when the market was at 15,200 or so. But, I mean, the numbers are rising now. How are things looking to you?
Yeah, good morning, Prashant. Like you rightly said, the volatility is in the peak. So we look into the quantitative part of it. The VIX, the volatility index is at almost 19.5. So this range of 17,400 to let's say 17,700 that the market is trading in. But this time, maybe in the last couple of days, we have seen the VIX go up. So I'm afraid that 17,700 would act as a good resistance. Now, because we are towards the lower side of the range, that is closer to 17,500, the risk reward is more to that bounce of 150, 200 points. And Prashant, one important thing I would like to say, the positions in the Nifty is almost, let's say, 1.27 to 1.3 crores, so that is the max we see in the last 6 months if we compare that. So either it can lead to a short covering, and we believe that the weighted average price of the short covering would come above 17,750. So if that happens, then the Nifty has more upside, maybe an 18,200 or 300. But as of now, the risk reward will be more on the buy side with a 17,450 as a stop loss, 17,700 as a target. If we cross that, as you rightly said, the short covering might come in, and then we might see a possible 18,200 on the index.
Okay. You want to give us your stocks for the day, Manoj? What are you looking at today?
Yes, Sonia, good morning. I guess TCS is one stock that I believe last couple of days there has been no severe long position. Rather, there has been some profit booking and shorts as well. So 3160 to 3170 is a resistance. So better is to buy a 31,000 put option for this month, September. But you try to buy between a 50 to 55 rupees. Keep a stop loss of 20, and the target would be closer to 95 on that.
Okay, all right. Thanks a lot for that. Those are some stock ideas coming in from Reliance Broking. Prakash Diwan is still with us. Prakash, any other themes that stand out for you amidst this volatile market that one can still look into from a long-term perspective? Any stocks?
I think Sonia, two things that very clearly feature in terms of the risk mitigation that you would want from global, headwinds going forward. And I do expect the markets to significantly lose some steam, especially I don't know where things could come from, where the negativity comes from, whether it's Europe or whether it's the US or China. But the markets seem to be in that state of, vulnerability in that sense. So the sectors would probably be more idiosyncratically domestic, as somebody mentioned in the morning. And those themes would probably be where the government is the largest spender or consumer. Or probably, we have companies which have not much of competition in terms of losing pricing power. So one is defense. I think the way that defense vertical is kind of, emerging so strongly in terms of companies getting depth and getting the capabilities to be enhanced, whether it's, already HL, which is run up, or whether it's the Garden Reach builders, those are very clear indications of what's in store for us and what we should be kind of putting our focus onto. The second is, I don't know whether I mentioned this or we've discussed this before. There's a very small company from the government stable called RailTel, which came up with an IPO last year, and it's still available at below offer price in that sense because, it didn't do so well probably of the market timing. But RailTel, is a company which is just at about 3,300 crores market cap, has a huge potential in terms of, the reach that it offers, 60,000 kilometers of cable connectivity on connecting all railway stations of the country. And there's much more to go. And when the government is willing to spend so much on reviving BSNL, I don't see any reason why within that telecom vertical on basic services, why RailTel won't feature. There's much more. I mean, we can always discuss that in length, but these are certain themes that I think are very promising and should be looked at from a long-term perspective.
Okay, the top traded stock in pre-open, by the way, is Suzlon. That's up about 8%. Of course, over the weekend there was a press release, and then they said that there was a typo, and the pledge was created in favor of SBI cap and not Adani. But Prakash, your thoughts on Suzlon? 8% higher in pre-open.
Yeah, so these are things that happen at times. These are fortunate coincidences that happen to certain companies, but it's not something which changes the context for the longer term investment thesis. But what's interesting, Anuj, is just since we're talking about Suzlon, is that the kind of focus that you will see on wind power going forward for the next 3 to 5 years, my sense is going to be much stronger and bigger than what we've seen for solar in the last 3, 4, 5 years. So this is something which is going to be center stage in terms of the renewable portfolio for most organizations. So be it the turbine manufacturers, be it the balance of plant suppliers, EPC constructors, all of them in that value chain will start getting to see a huge change in their order books and execution capability. So interesting space, but there's much more to choose from. So you'll have to wait and wade through that whole ecosystem. But there's lots that's happening which is very promising within that space.
Your thoughts on Reliance Industries as well, Prakash. I mean, I know your views already, but this morning there is a bullish note from Morgan Stanley that I just wanted to ponder over. Morgan Stanley has a note where they say that Reliance is now their top pick in the sector. They have a target price that they've raised to 3,085, which is a big upside to where the current market price is. Now, they say that this is the fourth investment cycle that Reliance is undertaking, and they are progressing very well on it. Remember, Reliance has announced a $50 billion investment over the next 3 years across 4 of their verticals, which is chemicals, 5G, retail, and new energy. And because of this, they expect their earnings to double by 2027. So that is the prognosis that Morgan Stanley has come out with. Also, they say that why they like the investment cycle this time is because it's supported with almost 1.5 to 2 times the operating cash flow and the EBITDA than the last cycle. So that's the note coming in on Reliance. Prakash, I'll come to you in just a bit, but we have Nimesh joining in to talk about the diagnostic companies as well and why they're in focus. Nimesh.
Hi, Sonia. There is an interesting report from Antique today on the diagnostic sector, and they've initiated a sell on Dr. Lal Path Labs and on Metropolis. On Dr. Lal, they have a target price of 1643, which indicates a potential 33% discount from current market price. And on Metropolis, they have a target price of 1232, a 12-13% discount from current levels. Now, the key reason why they've initiated a sell report, one, they believe that with competition increasing and the COVID-led tailwinds now behind, the industry is going to face a scenario of lower CAGR. In fact, they believe that the margins that some of these companies reported in FY21 will not be repeated anytime soon. So it will go back to the long-term averages of 10 to 12% versus 15% plus that was seen in the last few years. Even on return on capital employed, Antique believes that these will be under check and will fall down to 25-26% versus the pre-pandemic scenario of 33% plus that these companies reported for the last few years. So the valuation, there's going to be a valuation derating for the entire sector, and hence a sell report on both Dr. Lal Path Labs and on Metropolis from Antique with big downside targets. So that's something which stood out for me from the Antique note. Okay,
Nimesh, you also have a standard brokerage report, I guess?
That's right, Anuj. So the today's standard is on ABB. This stock has been on a tear, has been a big move, and Credit Suisse has now today downgraded the stock to underperform from neutral, and they have retained the target price of 2600. Again, a big downside from where the current stock price is. Now, the key reason for the downgrade is one, of course, the stock has rallied pretty hard, or 76% in the last 1 year, and even in the last 3 to 6 months, the stock has rallied between 40 to 50%. So that's been a big contention that the stock has rallied pretty hard. Now, while Credit Suisse believes that there is they see evidence of investment cycle picking up, but after the sharp run up, the stock is now trading at over 70 times FY23 price to earnings, which implies a much higher expectation from the street. Even on a DCF model, they see just a 20% CAGR, which is versus the all-time high margins of 20%. So, on back of big move in the last 1 year, and the valuation is quite expensive, they've downgraded the stock now to underperform. Within that investment cycle space, they still have an overweight on L&T, and they prefer Siemens over ABB purely from a valuation point of view. But the downgrade is largely on the back of a big run-up in ABB, and hence a downgrade to underperform now from neutral.
Okay, Nimesh, thanks a lot for that update. By the way, the pre-open has settled, and it's not bad at all, actually. It's Nifty is up about 6 points in pre-open. The bank Nifty is a bit flat as well. So largely flattish is how things will start. And then we'll take it from there. Sudarshan, if we open here, you maintain your call, try to buy the dip with 17,450 as the stop. I think that was your trade and your 910 call.
That's right. I would maintain that Nifty call. And my 910 call would be to buy UBL with a stop under 1660.
Okay, United Breweries is a buy for Sudarshan on Monday morning. Mitesh?
He said specifically buy the stock and not the product, right?
Yes, I know. Okay, Mitesh, your 910 call?
Yeah, I'll go with a buy on Tata Consumer around 826 with a stop at 817 for targets of 850.
Mitesh is going with Starbucks, right?
I would go with Starbucks as well, right? I mean, it depends on what your poison is in the morning. Prakash, what about you? What's your Monday morning poison?
No, I think I've had my share of coffee, but interestingly, what Sudarshan UBL, that's another pocket that's kind of coming out as very promising, especially companies that have been internally focused. Look at United Spirits. I mean, it's kind of surprised everybody with the move that we've seen, but I believe this is going to be an extremely promising space, and you'll hear about new brokerage reports and initiating calls on this, given that it's so under-researched or under-covered. So I would definitely allocate some money to the beverages sector within the consumption basket for sure.
Okay, well.
All right, we'll keep track of what happens. 9:10, which means there is 5 minutes to go as far as the pre-open session is concerned. Prakash, this entire gas story, right? I mean, the Russia-German gas story. Here in India as well, we've seen spot LNG prices go up massively. It's up 3 times in the last 3 months. We've had managements from, ceramic companies. Kajaria management was with us. They've kind of alluded to that. Although they made some interesting points, they said that because of what's happening, Europe, which was a big supplier to the US of ceramics, is now out of the market. They no longer are competitive. So it's not just it's sort of China plus one. It's China plus one, Europe plus one. So their volumes to the US are up big time. Although they added that domestically demand has been kind of poor. Your thoughts?
Yeah. So it's one of the reasons for domestic demand to contract is, of course, we are also, consumers are getting cautious in terms of their expansion and spends. That's for sure evident on the street. But what's promising is that, as I was saying earlier, it's not just specialty chemicals or tiles. It's going to be in a lot of other areas. And within the gas vertical, who is a better beneficiary or a bigger beneficiary than Reliance itself? I mean, you have the only company that has up to scale in terms of gas generation itself, and then you have this whole host of smaller companies within the value chain, Prashant, which are into exploration. So I've seen the way Hindustan Oil Exploration moved and then kind of almost doubled in the last 7-8 months.
Okay.
You'll probably see something similar happen to some of the vendors and smaller companies as well. I mean, there's one small company, I don't know how well it's covered, but there's a company called Stanley Exploration, which has been bought into by private equity, and there's lots that's happened. It's not delivered anything in the last many years, but on the business front, things seem to be kind of taking shape differently. So we'll probably look at something on those lines.
Okay, got it. Prakash, thanks a lot for joining us and have a good day. Let's move on then. Amit Dixit is joining us from Edelweiss to discuss the metal space. Amit, hi, good morning. Let's start with steel stocks first. What's your view? Because price action seems to indicate that the worst might be over. Your thoughts?
Yeah, hi, good morning. So what we see over here is that while, in terms of the stock prices might linger here for some time more, because what we see that the spreads are going to correct in Q2. And then the coking coal prices have also started rising. So therefore, with the low prices, relatively lower prices and coking coal prices rising, you might have a compression in spot spreads. That's what we are seeing. And hence, I believe that we still have some way to go before we call it, the beginning of, the bull cycle or the period when, clouds will dispel. It's still, I think it's very hard time for steel, particularly in terms of, export-oriented players such as JSW Steel and JSPL, where export realization are falling, export duty is there. So various headwinds are there. And therefore, we still are not optimistic.
Okay, so you're not optimistic. Prices are down, but are you noticing that even demand has fallen quite a bit, steel demand across pockets like China?
Yes, you're right. In fact, the demand has fallen quite a bit, and even in India, we are not seeing demand picking up. And the worst part is that currently our domestic prices are at a premium to the landed price of imports, and therefore, the import pressure could be there.
Got it. Okay, Amit, sorry, we'll have to leave it there today because we're running into market opening. Thanks a lot for joining us. That's the first rates now coming to us. The Nifty is opening higher by just about 10 points. So, not bad. The mid-cap index is opening about 100 points higher. The bank Nifty is opening higher. So, as I said, the things have been looking quite okay. ITC starts with another 52-week high. That's been really one of the strongest stocks. Eicher Motors has been the other strong stock, very close to its 52-week highs on Eicher Motors. I think in case of Eicher, it will be lifetime high as well. Tata Steel doing well. SBI Life. The Nifty is picking up pace now, 33 points higher. NTPC, Axis Bank, Titan, HDFC, ICICI Bank and Reliance. These are few stocks which are helping the bulls. Hindalco is now your top gainer, up 1%. Bajaj Finserv is up about 1% as well. And as I said, a couple of others like ITC, Tata Steel, JSW Steel, Larsen & Toubro are the 0.5% gainers. On the downside, a couple of IT names stand out. Wipro is down about 2/3 of 1%. TCS is down 1/3 of 1%. Apollo Hospitals is your top loser on the Nifty, down about close to 1%. Asian Paints is a bit soft. Bharti Airtel a bit soft. But look at the market now, and that's what we were discussing, that the basic texture of this market has been to buy the dips or consolidation. The amount of shorts in the system, let's see how things move. But for starters, 50 points higher on the Nifty and about 170 higher on the bank Nifty, Sonia.
Absolutely, looking very good. You have the mid-cap index that's outperforming really. 175 points higher now. The advance decline ratio is solid in favor of advances. Almost 2,000 stocks, so that's 6:1 in favor of advances. Stocks in focus, a lot of these companies that have exposure to the North American market, Bharat Forge, Ramkrishna Forgings, Madison are all up in the green. In fact, Bharat Forge and Ramkrishna Forgings now up 2.5% apiece. Do keep that on your radar. Reliance Industries, because of that bullish report from Morgan Stanley, is up almost about 0.5% now, trending a tad bit in the green. Angel One had a very solid report coming through in terms of their sales. So that one is up over 2% Keep that in mind as well. Suzlon is reacting up almost about 8% over there. A couple of these, consumer durable companies, whether it's Blue Star, Voltas, have been doing pretty well. Blue Star is up almost 2-3% today. PVR is charging up ahead, up 2% over there. Campus Activewear, Aptus Value Housing, Supreme Industries, Aster DM. Let's take a look at Aarti Industries as well. Positive commentary from the management, so that too is looking pretty good. The August disbursals for M&M were up about 75% compared to a year-on-year basis. M&M Financial is what I'm talking about. So M&M Financial is doing pretty well, up almost about 2% as we speak. So otherwise, good opening for the market.
Oh, absolutely. 50 points now, 52, 55, 17,593 is where we're at. Let me just take a look at a few other stocks, and then we'll bring in our market master. HBL Power is up 5.5%. It was up 10%. I think it was limit up. There was that large order which came through. It's an interesting company into various things. Small cap, small name, but huge volumes on this one today. Once again, Action Construction is kind of picking up from where it left off on Friday. That's up another 3% after the big move that it saw. And I'm only picking up names with volumes, nothing else. GNA Axles is up 4%. So these are the kind of names which are coming up on the top of the volume traded list, which is unusual. You'd have some larger F&O names which are here, but not today. TTML, of course, is another one which is up 6%. Just been one-way move on that one as well. Anything large on the way down? I think Paytm got mentioned, 3% lower. Hubtown is down 5%, coming up with volume. So that's all. Lal Path Labs, Nimesh, of course, was talking about those diagnostic companies. Lal Pathlabs is starting about 1.5% lower, but that's about it. I mean, not very much else. Otherwise, it's a pretty decent start with 72 points now on the Nifty. So this is getting bigger, at least right to the word go, 4 minutes into market opening. Our market master of the day is Mahesh Nandurkar, India strategist at Jefferies. And Mahesh is joining us on the program after a long time. Mahesh, it's great to have you with us here on CNBC TV18. Appreciate your time here, as always. Your first thoughts, Mahesh, on how you're seeing markets after, the recovery, the run-up that we've seen recently, and also contextualizing in the face of the U.S. market giving up almost 60% of its recent run-up.
Yeah, hi, Prashant. Thanks for having me here. It's always a pleasure. See, the thing is, I have been cautious, on the markets for a while, but obviously the markets have moved up, since then. And I can clearly see the momentum in the market is very strong at this point in time. We're seeing very, very strong foreign inflows coming through. Domestic flows maybe ease a little bit, but still quite strong on an absolute basis. And most of the fundamental parameters of the economy are also doing reasonably well. And also from the international standpoint, within the emerging market context, India is becoming more and more, a TINA factor, because many other emerging markets, are kind of falling out of, flavor for the international investors. So a lot of positive things coming up, for the market. So in that context, it's difficult to still maintain, a cautious view. But I think, from a medium-term perspective, from a 6-month, 12-month perspective, I would still reiterate my, cautious view here, because, while the corporate earnings are doing reasonably well, the economy is doing fundamentally well. But I think we need to differentiate between market movement and the economic fundamentals. These two are broadly correlated most of the times, but not all the times. And especially with what is happening globally, especially in the US in terms of the rates going up, the Fed balance sheet shrinking, etc., the dollar strengthening, all those things are definitely, not very supportive from the valuation standpoint. So I would still maintain my cautious view here.
Okay, Mahesh, good morning. Slightly different from what your colleague Christopher wrote, right, about at least the point he's making is that making China a bit neutral once again and allocating that money to India. And the big debate has been on fund flows, because we've started to see some amount of FI inflows, and it looks like a lot of this is strategic in nature, with money moving out of China back into India, which was perhaps not the case about 3 months back. But do you think that can continue, and maybe that will hold the market in good stead, valuations notwithstanding?
Yeah, so that is what is happening to some extent, Anuj. In fact, what has also happened within the emerging market context is that over the last 12 months, there have been 2 such occasions where people actually moved the other way around. That is, took money away from India and put more money into China. That happened once about 12 months ago, back in October last year, then again in May, June this year. And both these times, the investors did not really end up making money. So they really have a bad taste about going overweight on China. And India, by all means has done, very well economically, fundamentally, and, from the stock market movement perspective as well. So there is clearly that, force or, that factor to keep in mind. So as I said, from the momentum perspective, things are clearly in favor of the Indian markets here. But as I mentioned, valuations are becoming more and more uncomfortable. And as Prashant also mentioned, especially in the context of US, also we have outperformed quite a lot. S&P, is kind of down almost about 15% YTD. Our markets are just about flat. And even more so, the difference in terms of, in terms of NASDAQ as well. So, I basically believe that right now India is clearly benefiting from that TINA factor, as I mentioned, that many of the large emerging markets are not really finding, positive, kind of flows from the international investors. And, we're actually seeing that after a long gap of nearly 8-9 months, where we consistently saw about $4 or $5 billion a month kind of net selling the last 1 month has been very strong. But I don't want to take that flow for granted. That's what I can say.
Okay. Well, for now, a lot of stocks are hitting fresh highs. So let's just spot them. ITC is at a fresh 52-week high this morning. And the stock is at a dream run this year. It's up almost 50% for the year. Ashok Leyland is at a fresh 52-week high as well. So is Indian Hotels. Mahesh, good morning. How do you identify the next big trend for the market? I mean, there is a theme that's playing out, which is domestic consumption, whether it's autos, whether it's hotels, FMCG. Do you think that's a structural story or anything else that catches your eye now?
Yeah, I would say domestic consumption, is a good story. So even in the context of, my cautious views, I would say that these sectors, basically whether the domestic, staples or the discretionary consumption, be it hotels or, be it some of the other names like autos, I think domestic consumption, looks like a pretty strong story to me. Staples, while it still has some issues, pertaining to the rural demand, which hasn't really, picked up as well as the urban demand has. And, there are some cost pressures there, etc. But, I feel that it's a good defensive bet to take in the environment, especially if you think the markets are going to be stable to maybe, even downward moving. I think staples makes, a lot of sense according to me. And so does these urban consumption stories as well, like hotels and autos. So I think that's clearly, a strong, overweight for us.
But take HUL as an example, right? Stocks up some 40%, I think, this year, despite earnings downgrades over the last 2 years. And there is also a history of companies giving back some of these price increases when commodities start to turn lower. Your sense with these factors in mind, staples specifically, Mahesh?
Yeah, staples specifically, as I mentioned, there are, these issues pertaining to, the rural demand side. And I think what the companies are trying to do at this point in time is, take price hikes to pass on, the costs. And, maybe, do a bit of a, savings on the A&P expenditure as well. And that's how they've been able to maintain their EBITDA margins and, report PAT growth, which is reasonable. My sense is that, going forward, especially, and as we look at the next 6 to 12 months where the inflation is still going to stay high, the nominal GDP growth is going to be staying elevated at somewhere between, let's say, 13-14%, maybe 15% as well. So that's usually a good environment for some of these staples companies because they can report a higher nominal revenue growth and a higher nominal PAT growth. And as I mentioned, they have also been proved to be good defensives. So if you look at the last 12 months, there have been about 2 or 3 rounds of corrections with the markets correcting by almost 10% in each of those 3 occasions over the last 12 months. And practically in each of those 3 occasions, FMCG or the staples have ended up outperforming. And that's what I believe will happen probably over the next 3 months as well.
Okay, that's on staples. Which side of debate are you on in the IT space, Mahesh? Because there's one view that now with margins back to pre-COVID levels, valuation still 40% higher. Maybe they need to correct more. On the other side, there's a belief that the growth still quite clearly visible. Maybe this is a good time to get in. Your thoughts?
Maybe this is a good time to get in if you believe in the continued market strength, in India and probably, also globally. But increasingly, Anuj, and especially if you look at the comments made by the Fed last week, they clearly seem to, indicate that they will do, whatever it takes to get the inflation down. And I think that sort of, commentary would be associated with more rate hikes and I would say a greater probability of hard landing in the US economy. I mean, our own house view is that the current US unemployment rate, which is at about 3%, it's impossible to achieve a 2% inflation target with this kind of an unemployment rate. And, our house view is that the US unemployment rate needs to go up for the wage pressures and the broader inflation expectation in the US economy to come down. And I guess the Fed will have to act towards that. So if you keep those things in mind, and if you keep in mind the impact that it will probably have on the demand side or on the commentary, I believe that the risk reward is not really favorable for the IT services sector, especially because, as you rightly mentioned, the valuations are still very, very steep. And there is a possibility of some small disappointments coming through, if not actually on the numbers front, but possibly on the investor sentiment front, especially, if the US Fed keeps tightening.
Okay. There's a lot happening in the defense space, and I know it's a very small part of the overall market, but, the next company that we speak to also is doing something. They're building a warship, which is Cochin Shipyard. You have BEL, which has done exceptionally well. You have HAL that has had, a dream run. It's doubled in the last 12 months. Do you see any value here for long-term investors, or would you stay away?
No, I think defense and, broadly speaking, I would say the capital goods sector in general shows pretty strong promise, I would say. And while we might still be away from, away by a few quarters from the broad-based capex cycle recovery, etc., but there are many segments like you mentioned, defense. Then there is industry automation. And then there are some ESG-related capex plays. So I would say that many of these companies have also been reporting good numbers. In fact, in the latest quarterly result season, some of these capital goods companies actually stood out as very few exceptions where we saw earnings upgrades, while most of the other segments of the market saw downgrades. So I would say selective picks in the capital goods sector is still the right strategy in my view.
Okay.
You could look at, apart from logistics, apart from defense, you could look at some of the logistics names and some automation capex related names as well.
Okay, well, logistics, automation, capex, those are some big themes actually that have played out in the last 1 year. Thanks a lot, Mahesh. Appreciate your thoughts. Thanks for joining us on CNBC TV18. But let's take that discussion forward. In a proud moment, India's first indigenous aircraft carrier INS Vikrant was commissioned into service by the Prime Minister in Cochin on Friday. The largest ship built in the maritime history of India, Vikrant has been built at the Cochin shipyard at a cost of 20,000 crore rupees. The ship boasts of high levels of automation and has the capacity to operate 30 aircrafts at a time, including helicopters and the MiG-29 fighter jets, and will also hold the domestically produced light combat aircraft. Madhu Nair, who's the Chairman and Managing Director at Cochin Shipyard, joins us now to talk about that. Mr. Nair, good morning, and it is indeed a very proud moment. So congratulations first from the entire team of CNBC TV18. But you had no prior experience in building a warship, so just wanted to understand what are the challenges that you faced?
See, we had a strong experience in building large commercial vessels, also sophisticated functional commercial vessels for West Europe. So the experience in the technology was already there. But the challenges was, here the number of stakeholders and the kind of complexity, the size and scale is much more larger. So when you have different stakeholders involved, multiple systems involved, there are always gray areas. So ironing out gray areas and getting these entire stakeholders to work towards a single purpose, that was the most important challenge, and this probably led to a lot of going back and forth during various stages of the process.
Mr. Nair, hi, good morning. Prashant this side, and congratulations once again, sir. I mean, it's indeed a very happy, proud moment. Just a quick thing. So, are there any other sort of aircraft carriers? Is Cochin Shipyard going to be building the next one as well? Because I think there is one more in works, right?
It's not officially confirmed. There have been discussions at the levels and the military happening, but then the formal decision on the next aircraft carrier is not yet announced.
Okay. Right. Mr. Nair, just a quick point. This entire project, the approval to build this from the cabinet came through when Prime Minister Atal Bihari Vajpayee was there, right? I mean, under his leadership, when the first approval came through. So it's taken a long time for this to finally see the day of light, the lighter day. Now, if the next, if there is an order for another aircraft carrier which comes through, do you think the timelines are going to be, much shorter as compared to what we've seen in this case?
See, we need to understand this holistically. See, around 2004 is when Cochin Shipyard received the letter of intent, and the contracts came in much later. And the contract it was not a single contract; it was 3 separate contracts. Because this is a mammoth project, and it has been designed and constructed sort of concurrently. In the naval parlance, we call this concurrent design and build. So as you move forward, like initially the platform was configured, some of the major functional systems were configured. Then as you move forward, you gotten into the weaponry and the other systems. So how it moves forward is, it's not very easy to explain, but then such long projects, multiple systems, just to give you the feel of, see, there are about 550 companies involved. Some of the largest Indian industries, like from the PSU space, we had people like Bharat Electronics, HL, SAIL involved. We are Bharat Heavy Electricals Limited. From the private industry, Larsen & Toubro, Tata Advanced Systems, Kirloskar Pneumatics. Now, all these people, when they get involved, Wärtsilä India Limited, Johnson Controls. Now, when you're getting involved, there are conflicting requirements from various systems, because systems and solutions comes from the OEMs. And when there are gray areas have to be ironed out. DRDO steps in, the naval, various directorates of the Navy step in. This is how such a project moves. So, for India as a country, it's not just about Cochin Shipyard. As a country, like there was a steep learning effect here. For every entity involved here, for example, whether it's L&T or Bharat Electronics, there was a steep learning effect. Now, within the country, if you look at it as a nation, today there is much more learning in this whole space. Cochin Shipyard Limited has been at the center space. We have held this with focus over these long years. Formal construction actually started in 2007. And but for COVID, probably this vessel would have been delivered early part of 2021. So we are talking something like 13 years from keel laying happened in 2009. So from keel laying, it's now been 13 years. Now, if you are talking about a next aircraft carrier, if we are talking about something which is similar, at least on the platform size and scale, but we can make the requisite adjustments and changes for capturing the most emerging technologies on the weaponry side. If it is that way, then probably we are talking something like 7 to 8 years, maybe around that period from a firm decision. Okay. But if we are talking about something that's totally different, then we'll have to wait and watch and see what exactly are those differences.
Mr. Nair, because one difference from one difference is the size itself. So some believe that the next one should be much larger, 65,000 tons more. Is it will that largely shift, sort of be in your guidance?
That will definitely have an impact. That will definitely have an impact. See, the thing is actually like we need to get our staff requirements very clear, and that is for the Navy, what they want and how it should move forward. But if there are significant changes, I think there would be time again would become a challenge, because see, these are entirely custom made. See, all the systems, it's not you're not procuring things off the shelf.
Yeah.
Every OEM, everyone, whether it's the indigenous components or whether the imported components in this is all custom made. And it's not readily available. It is not that every aircraft carriers are not built just like that anywhere else in the world also. So if you're picking up something from Russia, it's not that the Russians have got ultra experience in this. For them also, there's steep learning in a new system. So The trick would be to try and keep the platform as close as possible to where we are. Changes to the extent that can be adaptable, let us use that word, that is possible. But if we want a totally new thing, then I think we'll have to go back to scratch, and the learnings will be there, but then the project will be from scratch.
Mr. Nair, can you tell us about the future in terms of any more projects in shipbuilding that you're looking at? What would the order pipeline be? Because even in the quarter gone by, the numbers have been very good. You're sitting on a revenue growth of almost 35% as of Q1. What does the future look like?
The order book looks generally positive. We have both the defense order book and the commercial order book. The defense order book, we have 8 number of ASW warfare corvettes, which we have already concluded with the Navy, which is about a 6,500 crore order, all the 8 vessels together. And we are L1 in the next generation missile vessels. This is another 6 vessels. The contracts are yet to be signed, but we hope the contract should be coming in. We were expecting it around now, but then probably in the next few months, let's put it that way, the contract should be coming. So with the defense, 8 plus 6 to come, so 14 vessels. The NGMVs are roughly about a 10,000 crore project. So that's the defense side. Now we have secured contracts from Germany for 8 numbers mid-size river coastal vessels. This we feel is a very important break for us from Germany, from the niche European short sea market. We signed contracts with Dredging Corporation of India for a very large dredger, which is about an 850 crore contract, and at least one more expected shortly. And this again is a very important contract for us because this is the first time India is building such large dredgers under the Make in India. It's only because of the Make in India insistence that the largest and the most technologically advanced company from Netherlands, Messrs. IHC, has teamed up with Cochin Shipyard for the dredger. We are sensing significant traction from Europe on vessels to support the emerging wind energy market in Europe. And we are pretty hopeful to secure contracts from Europe in that regard. So I'm generally bullish on the order book, and things should go generally well for us.
Mr. Nair, I have 2 questions. One, briefly, if you can, is there a debate in terms of a path ahead between building more carriers versus submarines? Or is going to be a combination of both?
There's a debate on which, Cochin Shipyard is not involved. Yes, there is a debate, but we are not. We are shipbuilders here. If we ask to build a ship, we build a ship. But that's actually a part of a military strategy.
Yes. Okay. Second question. With all that you said, it's good to hear that you are winning contracts. Sort of in Germany, Europe, and what you outlined. Is the pace from an investor's point of view, will the pace of earnings increase materially over the next many years? I mean, is there a long-range guidance you can give us, sir?
Again, I should be cautious here. See, this particular year, the current financial year where we are, we shouldn't be expecting too much of a increase kind of a thing because we are currently on a set of projects, as I said, but we are on the steel part of it. So we will get into the machinery and the more, let's say, more lucrative part of the contracts as we move forward in the next few years. So we are generally guided. See, this is an industry where you can't just go for steep ups or steep down. We target consistency over the long term. This is, if you look at our track record from where we got listed in 2017 till now, I think we have been fairly consistent in our growth. And I think that kind of consistency, if we can actually take forward, I should be happy, and this would be our targets. But we are not in an industry where we expect huge ups or sudden jumps. I think that would be too much to expect from our industry. But consistency, consistent growth, trying to hold on to good levels of profitability, this is the challenge we are doing. And mind you, we are not just a shipbuilding company. We are a ship repair company also.
Yeah.
And ship repair is we have integrated both together. So ship repair is also something where we are seeing good traction.
So this 10,000 crore order book that you currently have for the defense segment, how much of this could you execute in the first year, that is in FY23, FY24? Can you just break it up for us? Because you said that FY23 revenue growth will be marginal. I'm just trying to understand what the numbers could be based on your order book.
Would be a bit difficult because often it would be a bit difficult. But then see, this naval order book is to be executed over a let's say eight and odd years time frame. So you can see that's about a 16,000 crore order book to be executed over an 8 and odd year. So that is what should come out of an average from the defense part onto the shipbuilding side. So let's put it at 2,000-ish crore kind of a thing coming in a year. But then that's not, I can't say that this year we will have that much because as I said, we are on the steel side right now. You will have to mix this also with the commercial orders which we have. So the commercial orders happen much more faster. For example, the entire 8 German vessels we need to deliver. The first vessel will have to be delivered in 22 months' time. And we are already, this contract was signed in March of this year. So from March 22nd month, we deliver the first vessel and then one vessel every 2 months. So that's a much more faster, commercial vessels are delivered much more faster pace. So when you actually mix this, I normally would guide anywhere between 12 to 15% annual growth rate. This would be what we are targeting.
Mr. Nair, it's a pleasure, sir. Thank you very much, and congratulations from all of us once again.
Thanks a lot. Thank you.
For what you've done. Thank you very much, and hope to hear more from you as we go along. Maybe that next carrier, which of course Mr. Nair did not confirm, final decision has not been taken, but the buzz is there. There's very much on the anvil. We'll take a very quick break here. Up next, we have Patanjali Keswani of Lemon Tree Hotels who will join us to discuss how business is looking like. Mr. Keswani, of course,